Cramer, and welcome to my world.
You need to get in the game.
Firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
I always like to say there's a bull market somewhere, and I promise
Mad money. You can't afford to miss it.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain. I'm trying to teach you and coach you, okay? I'm trying to educate you. So call me at 1-800-743-CNBC. The most painful buys are often the most rewarding ones. That's what I was thinking about today. The average is meandered. Dow off 5 points. S&P rising a 0.25%, a little bit. NASDAQ advancing 0.28%. Nothing, right? But the stocks that have already had such huge runs, they ran again.
That was easy.
I'm talking about Netflix. I'm talking about Chipotle. I'm talking about ARM Holdings and Apple. Frankly, these moves, they are now beyond comprehension of us mortals. So I want you to come back with me. Come back to what I used to do when I ran my old hedge fund, swinging around $500 million, racking up 24% a year after all fees for 14 years. A yowza record that I have to draw on. To understand this market, this unfathomable market with its beyond reason favorites. Stocks that just keep going and going and going. Or are they really beyond reason? Yes, the moves in these momentum stocks are beyond reason if you're looking at them through the traditional lens of price to earnings multiples, which I always encourage. These stocks that go up every day are just too darn expensive on that basis, and I hear you. And you know exactly what stocks I'm talking about. So why don't we just stick, for the moment, we've got a bunch of them that we could use, right? But let's stick with Netflix, Chipotle, ARM Holdings, and Apple as examples, as they all work to illustrate what's really going on right now in this market and has been going on since the year began. What is going on? All right. What happened to Netflix that it was up another 16.5 points today? It's like a comedy club. We hear that Qualcomm has developed a chip that allows people to stream Netflix on Android-based phones. Chipotle up another 4 points. What's that about? Hey, Jack Hartung, CFO, acquitted himself darn well when he came on the show on Friday. I heard many people this weekend say they had to rethink not owning this great purveyor of Mexican food after the interview. ARM Holdings made a big splash at a gigantic mobile internet tsunami conference over in Barcelona, where all the big telco muckety-mucks with their equipment supply strut their stuff. Solid gains $1.50. Apple. Up about rumors about an iPhone Nano. It might be on the verge of being released. Tax on $2.38 on that bit of news. The problem I have is that all these reasons actually leave me cold. They're kind of central casting reasons. I mean, think of it. Chipotle caught not one, not two, not three, but 4 downgrades after that quarter. The sucker should have been down. It's like some kind of zombie stock movie where no matter how many times you shoot the darn thing, it just won't die. I don't know about you, but Chipotle made me feel like a plastic bag drifting in the wind, not unlike stock seer Katy Perry, who fared particularly badly in last night's Grammys. So if the rallies in these super momentum stocks aren't about any of the positive data points I just mentioned, what is really happening? And more importantly, how can you and I cash in on these gigantic moves? Simple. We got to stop thinking of names like Netflix, Chipotle, Apple, or ARM Holdings as individual high-growth stocks powered by news flow. We got to start thinking of them as a glorious asset class into itself. One that's attracting a huge amount of the money that is now coming into the market right now. Remember, the trends were to take money out. Now they've reversed since the year began. And it happens every day. The money piles in. We have Mutual Fund Monday. People put money to work. It's right here. The fact is, the money that's coming in right now is more important than what these companies say or do. Why? Because we are now in what I used to call at my hedge fund anointed territory. There have been some stocks that have been anointed by high-growth money managers who are willing to pay up to buy what they perceive as hyper-growth stocks without any limits. Put simply, these managers are addicted to growth. What would they do? They would catch a grenade for accelerated revenue growth. They would throw their hand on a blade for any company that's got exploding earnings. They jump in front of a train. Where's the train? Thanks a lot. that's taken share for a larger addressable market. And that Bruno Mars criteria has these managers buying Apple, ARM Holdings, Netflix, and Chipotle, regardless of where they're trading or what multiple they sell for. Because the only thing these growth funds know is that the sky's the limit for the stocks of companies that they think can grow for as far as the eye can see. There's no limit. I only know this because my friends at the Summit Elks often compare me to Bruno Mars. So maybe I have it, whatever it is. And I certainly have it when I play shuffleboard. Now, how about the Chipotle downgrades on valuation? As the analysts are worried about the skyrocketing price-to-earnings multiple it sells for 40 times earnings, 20% growth rate, company that is escalating food and labor costs, how can that be justified? These growth managers, they don't think like that, silly. They aren't constrained by simple relations between earnings per share and stock prices like we mortals are. They dream dreams, RFK-like, about things that never were, like about how Chipotle could be the next McDonald's, and ask, why not? Who cares if the multiple's at nosebleed levels? When you consider that McDonald's is currently 10 times the size of Chipotle, they think, I'm going to keep buying a stock until it's worth a fifth of what McDonald's is worth instead of a tenth. That's why when new money comes in and drives up these stocks, these managers aren't dissuaded by the valuations. They're not thinking like us. Same thing with Netflix. These buyers aren't fretting that Netflix is expensive at 37 times next year's earnings, 30% growth rate. They're thinking, hold it, some outfit they never heard of until today, Zynga, Z-Y-N-G-A, Zynga, some social gaming site that is nowhere near the customers of Netflix or the critical mass or the adoration that Netflix has, is worth more than $8 billion. I heard $9 billion for Zynga. That's what the paper said. Netflix has to be worth at least twice that, doesn't it? I mean, that gives it an additional $4 billion in market capitalization that you can just own. Call it 60 more points of upside if you're going to compare it to Zynga, because the growth hounds will not blanch. It's no different for ARM Holdings, where these growth buyers see the processor of the future, and they don't care what price they pay for heaven's sake. Remember, ARM's chip designs power nearly every mobile device out there. They're 4G. It's the brains of the smartphone revolution. That's enough to make a growth-oriented money manager totally forget about the fact that it sells for 64 times earnings, and it's like a bunch of British professors, like Oxford or like Cambridge or something. Apple? They actually think this one's dirt cheap. This is a value stock to them. Sells at 15 times next year's earnings, just 12 times when you back out the cash. You know what? I'm inclined to be with them. You know what price these growth managers would pay for a stock with Apple's growth? The answer is there's no limit. It doesn't really matter. Whatever is the last price plus a few dollars more. It's like Clint Eastwood. It's like a fistful of dollars and then a few dollars more for Apple. They simply have to have it. What would they do to own Apple? Cue up the Bruno Mars. All right, you see, I'm not catching that darn Bowie knife blade. I don't care what you say for that week that was. No. Anyway, they're really buying stocks of companies when you buy these momentum names. You are simply anticipating what the hedge funds and mutual funds crave. That's what matters. You're anticipating what they crave. The bottom line, you got to forget about the news. That's just the thing we foment for why people are buying it. This is about religion, and these growth stocks are idols. You may think they are false idols. I may think it's the twilight of the idols. However, in the end, these stocks, Netflix, Apple, ARM Holdings, and Chipotle, they are American idols. And these growth funds have the votes to take them to valuations that may make no sense to you. But it doesn't need to make sense, as these judges have many times your votes, meaning a whole lot more money. And they can and simply will these stocks to go higher, dog. And that's just what they're going to do. You can bet on it. Ashley in Pennsylvania. Ashley!
Hey, happy Valentine's Booyah to ya.
Right back at you, sister. Girl? What did she say? Sister. Yeah, sister. Okay, go ahead.
Well, as a newly graduated teacher in PA, I'm just getting started in the stock market, and I've been doing a little homework. I really believe in homework.
Good.
And it seems like a lot of people are not doing their homework about motricity. So,
well, Ashley, first of all, where are you teaching, Ashley?
I'm actually in Lebanon.
Oh, really? Okay, cool.
Yeah.
All right, I'm from Philadelphia, so that's good. Did you go to, Lock Haven or Shippensburg?
No, more like the Hershey.
Oh, okay, good.
Area.
There's a lot of schools that kids from Springfield High, Montgomery went to. Okay, here's the problem with motricity. It's the expectations. See, on the conference call, if you go back over, remember that line in the conference call where they start talking about Verizon and AT&T and how things are kind of running out of steam in the feature phone business. That took everybody's breath away. So, I mean, while you've done the homework, it's right. You got to remember that other people were looking for more growth from them. And even though you and I know that that stock is the right stock, they did disappoint people by talking about a flattening of Verizon orders. It did take my breath away, to be honest. Hey, why don't we go out to Carl in California, please, Carl?
Hey, Jim, a big old booyah from a Garden State transplant out here in sunny San Diego, baby.
Why would you ever leave New Jersey for San Diego? Who would do such a thing?
Beautiful. Hey, I got a question about Ion Geophysical, symbol IO. I want your thoughts on the China connection and this opportunity and shale gas play in the U.S. and the opportunity that exists in its joint venture in China with CNOOC, C-N-O-O-C.
Right, with CNOOC. With CNOOC. You know what? Look, here's my problem. That's an interesting spec play. I would love it if they would come on air. It's got great bloodlines. It's making a little money. But I got Core Labs. And Core Labs is the technology oil company, and Core Labs has been red hot. And we have Mr. Demsher on this. Look at that stock. It be smoking. I think you go with quality. You go with best of breed, and that means you're going with Core Labs. Now we're going to go to Bruce in Iowa. Bruce.
Jim, a big ag market booyah.
On your way. What's in your mind?
The stock market doesn't like uncertainty. And with the Tea Party and Republican-controlled House on one side, the democratically controlled Senate and the White House on the other, a fierce fight is looming over raising the federal debt ceiling. And if this results in a stalemate and maybe a closing down of the government like in the 90s, what market sectors would you be long and what market sectors would you be short to best ride out this political morass?
All right, well, first of all, I don't think it's going to happen, but let's just take it for what it's worth. You don't want to be in the banks if that happens because the banks always go down on everything that's bad at all in this country. What do you want to be? You want to be in diversified. You want to be in international stocks. That's why we think up to 20% of your portfolio can be in that. Or you want to be in gold. And gold's going to be terrific, even though all the naysayers are saying no. All right, do you feel like a plastic bag drifting in the wind? If Netflix, Apple, ARM Holdings, and Chipotle are in that bag, then it's the most beautiful thing I've ever seen. American Beauty style. Mad Money, be right back.